Hello, everybody, and welcome. My name is Barry Merrick. I'm co-founder and CEO of Ivy. I'm the chapter chair of YPO Metro New York, and it's my absolute pleasure to introduce all of you to Roger Martin. Roger, welcome. How are you today?
I'm doing great, and I'm looking forward to this, Barry.
Same here. I'm super excited. I want to thank you for being here. I want to thank everybody joining us live today because we have a really important, timely discussion. And I do believe it can be both life and world changing if we, as business leaders, deeply engage with this topic. So to remind everybody, we're here to discuss how we can play a role in saving democratic capitalism by overcoming our obsession with economic efficiency. Roger is truly an ideal guide for this particular topic. As I'm sure many of you are aware, he's a writer, strategy advisor, and in 2017, he was named the #1 management thinker in the world. He's also the former dean and institute director of the Martin Prosperity Institute at the Rotman School of Management at the University of Toronto in Canada. So Roger very recently, or right around now, published his latest book, which is called When More Is Not Better, which I have right here. And a lot of what we're going to discuss today are based on the ideas that he crystallized in that work. So Roger, thank you once again for joining us today. To kick us off, I want to ask you, what led you to writing this particular book? What's at stake here that you thought was so important that you wanted to focus your time and to really have this be the message that you share with the world?
Sure. I was motivated by observing something that had me worried. This was in 2013 when I kind of kicked off this work. And what I was worried about was that the trend in the growth of the median income of an American family had really stagnated. So up until the mid-70s, it had been growing for quite some time at about a 2.4% compound annual real growth rate, which means that you double every 30 years. So double every generation or so. So a median family could have the prospect of likely doubling their income in a generation, which is nice encouragement to kind of work, save, invest, etc. Since 1976, that had dropped by a quarter, the growth rate by a quarter, which means that the doubling happens in 100 years, over 3 generations. And so I was concerned that this would change people's affection for and dedication to this, what I think is a wonderful combination between democracy, a democratically elected government, and capitalism, right? The most of the productive assets of a country being in private hands. Because it was not any longer producing this outstanding reward for the populace as a whole. And if you want democracy, right, 51% of people have to vote to maintain it, right? Or democratic capitalism. And if that median family isn't advancing, they may say, yeah, let's try something else. And that motivated this whole study. I wanted to know why this was happening and what could be done about it.
Excellent. And just to really bring this point home, I mean, so like what's really at stake here if people, like if it doesn't deliver for them, are you concerned that like people will seek these like other forms of government, or do you think that,
yes.
Yeah.
Yes, absolutely. The last time we had a situation in which essentially the average family in an economy, in a developed economy, let's say, had their income stagnate was the Great Depression, right? 1929 to the mid to late 30s, depending on when you want to end it. And in that period, a goodly percentage of the advanced countries in the world went either fascist, socialist, or communist. Right? America didn't. America went left, right? Franklin Delano Roosevelt, that was a shift left on the political spectrum, but still squarely in the middle of democratic capitalism. There was an affirmation of that. But lots of countries chose essentially a fundamentally different system, none of which worked out so well. And the big difference here is during the Great Depression, what people don't realize, most people don't realize, is that the top earning families, the top 10%, 1%, their incomes fell more sharply than the median incomes, the average incomes, right? So at that time, all American families could say, this sucks, I hate this depression, but we're all in it together, right? What is different this time, there's two things that are different this time. The biggest difference is that while the life of the median family is stagnating, the life of the top 1% is getting better than it's already way better than it's ever been, and getting better every single year. So people can't say we're in this together like they did in the Great Depression. And the second thing is, in the Great Depression, it only took about 13, 14 years for income to both recover and double from where it was in 1929. This time, it's going to take 100 years, not 15, 16, 17 years at the rate. So this is a longer stagnation of middle incomes, and in a context where some people are doing fantastically. That, I think, is a big challenge to people's willingness to say, we're gonna keep doing this. We believe in this system, and that worries me.
Thank you so much for that. And I want to ask you, so we're going to go into the way we're going to structure our conversation. We're going to go into what are the key drivers causing these challenges. We're going to then talk about your proposed solutions depending on, you know, as a business leader, as an individual, policymakers, and so forth. Before we dive into all of that, though, I do want to understand, like, how much of this, of both the challenges you've identified and the solutions, how much is it driven by, you know, empirical kind of demonstration of what works and what's already worked historically or in other societies? And how much of it is also a little bit speculative in the sense that, well, you chose to focus on the US as a case study here in your book. You know, the US itself is a grand experiment. It hasn't been around that long. And like, no one's really done this before, right? So I just want to understand, like, how you balance that in your work to come up with all of this so people can understand your methodology. Are we looking to emulate others who found success, or are we just thinking about, like, what's more likely to work based on what we piece together from history?
Well, it's a combination. I mean, I took the perspective, I'm an intensely practical guy. And what I said is, rather than having a book that sort of theoretically says, well, you could do this, you could do that, these things that have never been done before, I have 18, we'll get to them, I'm sure, some of them, but I have 18 recommendations in the back half of the book. And the only way you could get to be a recommendation in the book is the thing is being done now here, is being done now somewhere else, has been done here or somewhere else successfully. So it's intensely practical. Nothing in this is theoretical, like we should theoretically try to do this. It's all being done, and just isn't being done ubiquitously enough, fully enough. And so I think we can fix the problem that I described by taking tried and true methods for doing it, and not having to try something kind of completely new and you know, kind of out of sight. And you referred to other countries. Absolutely, some of these things come from other countries. Things that are done in, that have been done in France, things that have been done in Canada and elsewhere.
Excellent. All right. Well, so what I'd love to do now is, first of all, I want everybody to take a moment here, whether you're participating live or listening to this recording subsequently. I want everybody to think about, like, why you're here in this conversation. What's the intention that got you to tune into this? What are you hoping to get out of it? I think it's really important to focus on the purpose with which we do something, and then really commit to fulfilling that intention. So I'd like you to think about that. I'm going to share with you, my intention is I want to be able to much better articulate kind of the key drivers of what's happening with the US economy as a bellwether or canary in the coal mine, as Roger was telling me the way he sees it for economies around the world. I want to be able to not just articulate it better, though, what's happening, but rather I want to know what I can do as an organizational leader, as a citizen, as somebody who wants the best for the world. So that's my intention. I'd love for the people who are participating live, please share in the chat window why you joined us today, what you're hoping to get out of it. That would be great. And those who are listening to it as a recording, still write to yourself a sentence. Why are you here? And then push me and Roger to make sure we deliver for you when we get to the audience Q&A by asking your questions. So Roger, with that being said, please let's kick off and let's go into what are the key drivers that are causing these challenges. How come families could expect to double their incomes much faster in the past versus now? What's going on? Aren't our technologies better? Aren't we better at running governments? Why are we screwing this up?
By accident is the answer. So what we've done is inadvertently adopted a model for managing the economy that is changing the shape of the distribution of outcomes. So to explain that, we've always had a belief implicitly in democratic capitalism that the outcomes, the outputs of the economy would be in some sense bell curve shape, normally distributed, i.e. we'd have, everybody thinks about having a really big middle class in the middle, a smaller number of rich people, a smaller number of poor people, and that's what the economy will produce. And a good economy, a good society will tax the richer families in that tail more highly to help fund the lives of the poor families and hope to provide them with the opportunity for mobility. And the belief is if we became more efficient in the economy, what would happen would be the rising productivity that comes from that will move that whole distribution to higher and higher incomes over time. So that bell curve will march, if you will, to the right, so that the median family will advance. Poor families will become less poor, richer families will become richer, but not disproportionately so. So the approach was to say, we must maximize efficiency to make that movement happen. That's what will get us moving. And we had a sort of a view, kind of a quasi-scientific view that said, well, the economy that we're trying to make move right to produce these better outcomes is kind of like a big machine. And we can break it into its pieces and we can maximize efficiency of each piece, add them back up, and ta-da, we'll have this great move in the direction we want. That was the theory. But it turns out that what we didn't realize is that if you kept pushing obsessively on efficiency, right? You open up trade, deregulate, allow mergers that create short-term efficiency, look for efficiencies in the capital markets, bid-ask spreads, narrowing, all of that stuff. If we push hard enough on that, actually the shape of the curve changes, and it changes to what's called a Pareto distribution or a power law distribution, named after Wilfredo Pareto, who noticed that in the late 1800s that 20% of Italian families owned 80% of the land, and that's why it's called the 80-20 rule. It's a short form. And in that distribution, it looks not like a bell, it looks like a ski slope with most of the observations at the low end, and then a long, long tail where the tail goes on forever. And so what's happened is that we've inadvertently done that to the economy. And that's why now, when the economy grows, the likelihood today of that incremental dollar of growth going into the hands of somebody in the 99th percentile is huge. It's highly likely. The chances of that going into the pockets of somebody at the 5th percentile is minuscule. In 1980, it was exactly the opposite. There was the highest percentage likelihood of it going into the pockets of the person at the 5th percentile, and lowest probability in the 99th percentile. So something has happened in this last 30 or 40 years that has shifted the economy to one that is creating this more Pareto distribution with a long tail, with rich people, rich individuals at the end getting richer and richer and richer, so that inequality is off the charts. The top 1% is as richer and earning more than any time in American history by far, right? The same thing is happening in companies, right? In industries where we're having greater consolidation and domination of fewer players in industries. Fewer players make up the bulk of the value of companies on the S&P 500, a greater percentage of the earnings. So everything is, rather than getting balanced among many, it's extreme to the benefit of few. So we have a fundamentally different economy. Now, there would be conspiracy theorists who say, oh, that was the intent of some. I do not believe it was an intent of anybody. And this happened across a 50-year period where it was half Democrats, half Republicans in Congress and the White House. Rather, it was a mindset, a philosophy that said it's a machine, it's perfectible, and the way you perfect it is put more pressure on it for greater and greater efficiency, and everything will be great. Oops, it isn't. Everything is different, not everything is better.
All right, thank you so much for setting the scene. The part of me that's an econ major that loves history, political philosophy, I can't help but wonder. Like, as I was listening to you, I was thinking, wait a second, let's rewind like 500 years, right? Where most people are serfs working on farms. You have these lords who were like the warrior class, and and then we somehow evolve industrialization, fast forward, trading class and so forth. But still 100, 120 years ago, New York, London, these were pretty horrible places to be, not at the top of the society. But somehow, some way, the political systems evolved, right? Certain countries had their revolutions and
yes.
Autocracies getting established, but then certain countries managed to adapt and balance and I guess, avoid, their rulers getting beheaded and so forth, right? So I'm just curious to what extent it's different this time, and or more importantly, I mean, you outlined like what was different in the recent past and also compared to the Great Depression. What I'm looking to understand is like, is this the kind of thing where like, look, that's the whole point, democratic capitalist systems, they adjust. So if people are going to start rioting or voting into power, like scary people, that's going to take the wealth away of the top 1%, there'll be concessions made and it will adjust. Do you think, I guess, yeah, like, will it naturally happen? Or do you think that actually, no, without some serious interventions by all strata of society, this is going to just get worse and worse? We're going to keep trying to become more efficient. Curious how you see it.
Yeah. Yeah, sure. Well, a couple of things. I mean, part of what you're saying is about, didn't this system provide a great amount of progress over that period? And my answer would be absolutely, right? So, in some sense, the first 200 years of America's time as a country had the system working quite well. Now there are lots of problems to solve, social problems and the like, but it was moving in the right direction, and in this all the way up through the 50s, 60s, 70s, or 60s at least, not in the 70s. There was social mobility, so that actually if you started out in the lowest quintile of the income distribution, you had a decent chance of getting into one of the upper quintiles. So efficiency and the pursuit of efficiency wasn't a bad thing, and it actually helped create stronger country with these outcomes that are, the cities aren't miserable to live in, there's safety in the workplace, all those things. It's just, and that's why I call it the book When More Is Not Better, is when more is not better. The title is not more is not better, it's when. And that's the problem, is that we pushed this theory, this model, past the point where it was increasingly productive to where it's become increasingly unproductive. And in terms of the future, Barry, I mean, I do worry And one thing that has changed dramatically since I started this project in 2013 is surveys on, do you think socialism would be something to try in America, right? It got zero almost, 10 years ago, 7 years ago. But now, lots of young people especially say, hey, it might be worth a try. That's what I'm worried about. I am worried about adoption of a fundamentally different system because we have stopped believing in this one. And in terms of your other part of your question is it going to continue to get worse? Yes, because one of the things about Pareto distributions that we're now into is Pareto distributions get that way and become more extreme when there's a certain feature in place. And that is when effects become the cause of more of the effect. So think about it on Instagram. The median number of followers for a person on Instagram is between 100 and 150 followers. The greatest number of followers for somebody on Instagram is, last time I checked, at least Cristiano Ronaldo, and it was 215 million when I checked last. It's probably 280 million by now, but when I checked last, so 1 million times more than the median person. How could this be? Right, in a normal distribution, if you look at the distribution of male adult height, the tallest male in the world is less than twice as tall as the median male in the world. So that's how tight that distribution is. Here it's 1 million times more. Well, it's because being tall is not the cause of more tallness. In fact, there is a known regression to the mean. But having a lot of Instagram followers has what effect, you think? Getting more followers, because when you go on Instagram and somebody's got 2 followers, do you say, oh, wow, this looks like a great idea to follow this person? No, but if they got 1 million followers or 200 million followers, you say, well, it's good for a lot of other people, it'll probably be good for me too. So the effect, having more followers, is the cause of more of that effect still. So it becomes more extreme. These aren't stable distributions, right? They're distributions that are becoming kind of more and more extreme over time. And that's, I mean, there is an old saying, you're an entrepreneur, you know this, the way to make money is to have money, right? If you have money already, it's easier to make more money. Well, that's the effect, having money, cause of more of the effect, making more money. These are not stable distributions, they're increasing. And so unless we take some steps to change how we are essentially running the economy, and I am avowedly apolitical. This is not left-wing or right-wing. All I'm saying is that if you care about democratic capitalism, right, which I think people on the left and right care about, unless we take steps, there will be a crash, and I don't like the likelihood of outcomes, right? How did fascism work out for the world, after the Great Depression? Not so well. How did communism work out? Not so well. How did true socialism work? Not so well. And some people ask me, oh, Roger, shouldn't we be socialist like the Scandinavia? Scandinavia is not socialist. Scandinavia is, lots of about Scandinavia is super clever capitalism, right? Where is corporate tax rates lower, Sweden or the US? Most people would say, oh, of course, the US, home of the brave and the free. No, they're lower in Sweden because they're really clever capitalists. So that's if you look at it, what I think of as true socialism, where the government owns the majority of the productive assets of an economy, that hasn't worked out either. So that's why I'm so, as you can tell, passionate and adamant about doing something about this.
Absolutely. And that's a perfect segue to now really crystallizing this into action. And as we all know, and probably it's not a bad thing, it's not like there's just a group of people who decide, okay, so here's how we should fix our economy. It's actually all of us participate with our purchasing decisions, hiring decisions, employment decisions, investment decisions. And then some of us obviously influence policy, some of us make policy, some of us aspire to do all of those things. So let's work through this, the different ways that you've identified also in your book. When it comes to solutions, you've created these, like, what's the agenda for business executives, political leaders, and so on. So share with us, first of all, like that achieving the balance, like that underlying
Yes.
like the solution. And then let's take each in turn. Let's start with business executives, what we can do. And then from there, we'll go to different subgroups in society that we might belong to, or we might be able to influence to nudge in the right direction to save the system that has given us so much.
Perfect. So you're right. The first thing to establish is this notion that it's not that I would want us to stop thinking about efficiency. No, but I'd want us to start thinking about a balance. Rather than more efficiency is always good, it's efficiency balanced with resilience, because we want to have a system that's resilient over time. And in essence, I'm saying that democratic capitalism, as prosecuted in this country, is less resilient, right? Because of the way we've pushed efficiency, and that means having a balance between sort of the pressure we put on for more efficiency and the friction we put in the way of that to create a balance. So for executives. One of the things that I think executives have to think more about is making sure they don't have one single objective function. That's what they've all been told. You went to business school, you went to a leading business school, Barry, and you were taught the importance of having a clear, singular objective function. That's generally been make more profit or make increase shareholder value. But it turns out that when you have one and you're obsessively pursuing one, what tends to happen is something called surrogation, where the desire gets incorporated in a proxy for that. So increase shareholder value, the proxy for shareholder value is today's stock price, right? Right. So that immediately has you saying, if my stock price today is higher, I've created value, that measurement. When you do that, you then start doing all sorts of things that are focused on that thing, like cook the books, like go to Wall Street and hype the stock, all sorts of things that actually aren't good for resilience, which would be having the company perform well for customers, for employees, so that it's around 10 years from now doing better. And sure enough, shareholder value will take care of itself if you do that. And so rather than having a single goal, and when you have a single goal, things like the Wells Fargo scandal happen, right? Goal is better customer relationships. You reflect that in a proxy of number of accounts per customer. You create incentives for people in the branch to have more accounts per customer. What do? Do it the easy way. Open accounts that the customers don't know about, and you have a gigantic scandal that costs you tens of billions of dollars and destroys your reputation. What I like better is something like Southwest Airlines that say, we want to be the lowest cost airline and the highest customer satisfaction and the highest employee satisfaction and most profitable airline. And you'd say, well, those are internally contradictory. How can we be lowest cost and highest employee satisfaction? Well, the answer is you got to be cleverer, which they are, right? They create a system that enables them to do all those things together. And so for executives, I think they've got to think about pursuing a more diverse, if you will, objective function, multifaceted objective function, which is directly against what they were taught in business school, unfortunately, but is consistent with many of the most successful companies in the world. So that would be one. A second one is businesses just got to rein in this obsession with reductionism, right? Businesses are run as here's marketing, here's accounting, here's finance, etc. Each of them specializes in their thing, does their thing, maximizes their own objective function, and we add it up and we hope that works. It doesn't. The great Peter Drucker said it best. There are no accounting problems, there are no finance problems, there are no marketing problems, there are only business problems. And we've got to think about business problems more holistically. The other thing I would say about business executives is they've got to start recognizing that slack is not an enemy to get rid of 100%, right? Lots of the people from Adam Smith to David Ricardo to W. Edwards Deming who would be rolling over in their graves seeing what their work has been taken to, right? So Edwards Deming, the total quality guy, eliminate waste by having quality in your system. In his name, right? People are doing Six Sigma, getting rid of every bit of slack. And Edwards Deming said there's an optimal level of slack that isn't zero. Meanwhile, we're treating it like the enemy and getting rid of it. So those three things I would say would be the top three things I'd say for businesses to do. They've got to think about multiple objective functions, multiple measures, recognize that there's an optimal level of slack, and start operating more holistically where you aren't reducing everything to their silos. Because there's so many problems that are created by that. Telling your operations people to kind of get the wage bill down while you're telling their HR people to hire great people, right? It ain't going to happen when those two are left to their own devices.
Excellent. Roger, thank you. This is great. And what I want to do is just before we move to the other segments, because everyone here is a business leader, this one I want to spend a tiny bit more time on. Yeah. So let's just come up with something very, very practical, like a challenge for everybody who's engaging in this conversation. So for the first point you made, you said, don't have a single goal. Basically, if you just optimize for the one thing, you might be really sacrificing sustainability because you might be hyper efficient at that, but you might not be able to take the knocks from competition or an evolving world. So one thought I had there is, well, obviously we all know what a P&L is and what the bottom line is. We can't not measure that, right? Hopefully everybody cares. Well, there are certain companies not incentivized to do that as much in Silicon Valley, but for most companies, obviously the bottom line, that's a good anchor. But the other one seems to be, it can be boiled down to all of us maybe asking, okay, so what's my non-profit related metric, which if I quote unquote optimize, can help me become more sustainable. So you mentioned employee satisfaction surveys. Obviously, just broadening that, customer satisfaction, vendor satisfaction. If people that you deal with are satisfied with you, and you can also measure that, like we send a survey with 0 to 10, to what extent would you recommend this after everything we do? Yeah. Obviously, if that, along with your profit metric, that number is going up rather than down, it's likely that the community that you work with to deliver what you're looking to deliver is going to last longer.
Yeah, it's going to be resilient.
Yeah, so maybe for everybody here, I mean, the challenge I'm going to make to myself too is like, how do we do even better at that non-profit metric for sustainability? Second one is like, this one was a little bit more esoteric. So like, make sure it's a business problem. It's not a marketing or ops problem. Share with us, like, how specifically do you mean by that? So when something comes up, like instead of just marketing dealing with that and getting more sales done or getting ops to reduce costs, are you saying that like these need to be done more collaboratively? Or is it solving for that, on the first point, solving for that nonprofit metric will require for ops to collaborate with HR to make sure that if they're cutting people, they're not doing it in a way that's going to cause other people to leave?
Yes. So yes to everything you said, and you're right. There's a linkage. It is a big, complex adaptive system, and those things are linked. But I would say on your first point for leaders, everything you said, I agree with. And I would also just say, as leaders, reject it when people come to you and say, boss, you have to decide what we're maximizing. And they will say that in many ways. Boss, do you want us to maximize this or this? And I think the correct answer is yes. Right? Right? Yeah. I want you to come back with a clever way of getting both of those things. Don't let them trap you into saying, okay, it's going to be customer satisfaction. We don't care how miserable that makes our employees. No, that's not good enough. Or it'll be all customer satisfaction, and we don't care what it does to the bottom line. It's no, that anybody could do, a robot could do, right? But it takes real cleverness to do both. So that would be my advice as a leader on that. I think when you do that, you will more naturally recognize that you do have to have people working together. But here's again where there are two fundamentally different styles I observe when working with CEOs and others, other senior executives. One is a style where they want multiple sequential one-on-one meetings with their direct reports. Let's say it's the CEO and it's the C-suite. I will first meet with the head of marketing. We'll decide stuff. Then I'll meet with the head of operations. Then we'll decide stuff. Etc. Multiple individual sequential, and others who say we better get the people around the table and make a good choice. The latter is just plain superior to the former. Is it easy? No, it's not. Can you waste a lot of time if you don't have a carefully crafted agenda for that? Yes. But in the end, it makes for better decisions because they're more consistent with humanity. Humanity doesn't operate in those silos, right? So why would you think that business, which is here to interact with humanity, could operate that way and it'll work out well? Yeah, it just plain won't. So those are kind of little things that a business leader can think about that will migrate them towards making more holistic decisions that are more consistent with the world around them, rather than trying to impose themselves on the world. The world, if it's business versus the world will win.
Excellent. And I guess like a deeper one deeper thought I had based on what you just shared is, I mean, it's also like paradoxes are like at the heart of all the best things we've created, right? We want freedom, but then for us to all be free, well, then we have to have some constraints. And, so I think like the Southwest example is a great one. Like, yeah, of course, it's a business. They want to be profitable, but the way they're going to go about it is give excellent service while keeping low costs. It's okay though if you have that paradoxical goal, because then it forces you to be, as you said, clever, and that's why you deserve the returns on the sustainability that you get.
And just on that point, so I think you're absolutely right, Barry. And on that point, what human beings tend to do when they're faced with those paradoxes is think they've got to make them go away, got to get to a quick resolution. And sometimes you just have to marinate in them for a little while. So I would say to everybody on this call, give yourself time to think, right? Don't push yourself to make a decision super fast because you think that's the decisive leaderly thing to do, right? I remember, I did a lot of work with A.G. Lafley, the quite famous ex-CEO of Procter and Gamble. And he would say when somebody came to with a paradox of that sort, his immediate reaction was to say, this is something I'm going to have to sit back and think about. I am not going to send them away with an answer. So he used it as the paradox is a red flag that says, this is the time to engage and think hard. This is the time when you can create a whole lot of value, and you ain't going to create a whole lot of value by saying, as with that paradox, I'm siding with A or I'm siding with B. Nope, neither is the right answer.
All right, excellent. Thank you so much, Roger. So now diving into the other stakeholders at play. So clearly, there are political leaders whose job it is to also maximize not just economic output, but also balance everything so that everybody can thrive best they can. So share with us what you thought would be the agenda for political leaders, those who are willing to listen. What's the best way to navigate this? I love also what you said yesterday. It's not left, right, whatever. It's just more about, based on your research and findings, what do you think is the best way to still incentivize the risk takers and the people who are willing to work harder while also ensuring that structurally sustainability is also baked into the system and not just efficiency.
Yeah, well, the most important thing I think for legislators, for political leaders, is this idea of writing revisions, the requirement for revision into all laws. So what we've gone to is this sort of scientific mechanistic view of the world that says we can figure it out and devise a perfect solution. And that's what Washington keeps trying to do. It's sort of like, oh, we had the dot-com bust. We must solve that problem by putting in place Sarbanes-Oxley, so this kind of thing will never happen again. Well, 7 years later, something dramatically worse than the dot-com bust happened. It's because any system you put in place, will not be completely right, because it's impossible for human beings to understand a complex adaptive system enough to predict what will happen. And two, even if you sort of had right predictions based on the system that you were looking at, it'll adapt, right? Did the Fed, right, which kept interest rates low after the recession that happened after the dot-com bust, they kept interest rate low to stimulate the economy. What they didn't count on is an adaptation to that, right? Which is all these companies going out and convincing everybody to get subprime mortgages because the rates were so incredibly low, which inflated real estate prices, which caused a bubble, which caused it to crash. Now, I don't think we would have had the crash if we wouldn't have had adaptation. Right? If people would have continued to operate the way they did, only with the benefit of lower interest rates, we would have been fine. But that's not how complex adaptive systems work. Everybody jumped on it and said, oh, wow, we can exploit it to our own benefit in this way. Governments have got to realize that will always happen. Not some of the time, not most of the time, all the time, right? A tree, like some of these things, like a tree, if it's growing behind another tree, right, will bend its trunk and its branches so it gets more of the sunlight. It's automatic that this will happen, and the only way to deal with that is to say whatever we do is going to be proven wrong. There is going to be adaptation to it that we don't like, and we're going to revise it, right? This is what I like about software companies, right? Do software companies, when they come up with release 1.0, do software companies say to you, the user, this is going to be perfect? No, they say, this is our first version, it's going to be full of bugs, and if you want to buy it early on because you're kind of a geeky kind of guy who likes to find bugs, awesome, and just, email us to tell us about the bugs, we'll fix it, and then we'll fix it, and we'll fix it. And everybody's just cool with it because they know 1.0 is going to be buggy. Right? They don't say it's going to be perfect and then it's full of bugs. They say, trust me, this is going to be buggy, right? That's what politicians should be saying. Trust me, this is going to be buggy, and that means we're going to have to revise and tweak as we see how it's being used. You can say, oh, Roger, that's theoretical. How could they possibly do that? No, the absolutely most important central regulation in Canada in the financial services sector is the Bank Act. It's called the Bank Act of 1871. They were wise enough in 1871 to write into the Bank Act that it had to be formally reviewed and revised every 10 years. So it was not a political thing. It wasn't the party in power says we hate the banks, and so we're gonna change the Bank Act. It's 10 years, and the law insists that we do that. It actually got shrunk to 5 years in 1992, and they were wise enough to say, do we know how the banking sector is going to evolve in this country as of 1871? Hell no. We got some ideas. Here's the legislation, but you got to keep revising it and revisiting it. And as a consequence of that, in part, the Canadian banking system didn't melt down in the global financial crisis. There were no bank bailouts, no bank failures, no nothing, because in part we had more flexible, changing, adaptive legislation. So that more than anything else would make a difference when it comes to political leaders.
Got it. Just very quick, in a nutshell, like in less than a minute, if you could share with us what specific policy though have you seen that is clever in the sense of like it incentivizes, let's say, business decision makers, it incentivizes also local governments to follow incentives in a way that actually helps bring about um, what you're promoting here, which is like, how do you like get these different stakeholders to like pursue their interests, but at the same time, all of a sudden now they have an interest in making things sustainable as opposed to optimizing for today's stock price.
Well, I mean, it's very, very unpopular in the auto industry, but I really like cafe, right? Back in the 70s, when we suddenly realized that you know we have to make cars more fuel efficient, the government said fuel efficiency now on average is 13.5. In 10 years, it's got to be 27.5 in the fleet of cars that you sell in a given year. You figure it out. I like that much better. That's output regulation rather than input regulation, right? It treats it as a complex adaptive system. You guys can figure out better how to make that happen than us. We're not going to say cars have to be this small with these kind of engines, with this kind of materials. It's like, you figure it out. And the whole industry, you know, screamed bloody murder and said, it's impossible, it can never be. And all of them hit the target. So I think I just like government legislation, regulation that assumes a complex adaptive world, assumes that it doesn't know how everything has got to work to make it better, but provides that sort of structure that says, this is the output that we want, you go figure it out.
That's powerful, and it's giving me ideas, which we'll have to discuss another time, around like, could you legislate that stakeholder satisfaction being rewarded, for example? Like, you know, you maybe pay a little less tax if all your stakeholders think that you're a 9 out of 10 or above company, the way your employees think that, your vendors think that, and your customers.
Yeah, I know.
Some ideas, but I love the general idea of like, you know, regulate the output, let the innovators figure out how to get there, as opposed to taxing the inputs or, you know, impeding them.
Yeah, you want to harness the adaptivity of the economy in positive ways, rather than harness it in negative ways, in creating the opportunity for really negative gaming.
Excellent. Thank you, Roger. So we've got some amazing audience questions, so I'm going to start diving into them. There's a whole group of them asking about, like, you know, citizens, educators. How do we, you know, like, what are the key action steps? So as business leaders and political leaders do what they do, what does the individual do, and what the teachers do?
I can give a very quick, I can give just a very quick one on individuals and a very quick one on educators. On individuals, multi-home. So when we choose that we're going to buy everything from Amazon Prime, always use Uber, get all of our news from Facebook, we are contributing to these Pareto extreme outcomes. And all I'd ask citizens to do is, you can like Amazon Prime the most, just some of the time, a minority of the time, go to a store or buy from somebody else. If you like Facebook, fine, get most of your news from Facebook, but subscribe to one local newspaper. If you like Uber, fine, but take a taxi every once in a while. All of those things will have a bigger effect than you would imagine on stopping this winner take all from happening. So that would be for citizens. And for educators have just got to stop teaching certainty. There's more certainty taught where there's a right answer and a whole bunch of wrong answers. No, there's just better answers and worse answers, and the better answers are going to change over time. Right? They should learn from the history of physics. We taught Newtonian physics as the right answer for 150 years. Then we got a little embarrassed and said, "Ooh, this guy, you know, with fuzzy hair who didn't wear socks, Einstein, actually figured out that it was mainly right, but not entirely right. Let's stop acting as if we can teach what is right, and rather teach people that there are righter and wronger things, and the rightest things are going to be proven wrong over time, and we got to keep migrating and iterating. Those would be the educator and citizen things.
That was great, Roger. Thank you so much. In short, you're basically saying as citizens, buy from more than just one provider for a given service. And for educators, embrace the fact that there's uncertainty out there. Just like physicists continuously have to do, keep proving that we don't know anything, but we keep getting better at it. So thank you for that. So first question after that one is from Bill Best, who asks you, please, Roger, comment on the notion of generally using values and principles versus prescriptive rules in how we pretty much approach everything.
Yeah. Well, I would just be, I think, where the questioner is, which is values and principles are going to get you farther than rules. There's no great dish ever made by a chef who followed a recipe assiduously, right? It's a guideline, right? It's a guideline that's generally speaking what works, but depending on the room temperature, the specifics of the ingredients you happen to have, when you're going to serve it, all of those things, you have to use your judgment that comes from your sophisticated understanding of the situation to tweak it to make it the best, and that's what principles and values are. Rules. I don't mind giving out kind of rules, but indicating that here's what's behind the rule, and if the situation that you're facing appears to violate what's behind the rule, I don't want you to obey the rule. Generally speaking, though, this is a better rule than not. Just like a recipe, generally speaking, that's not a bad way to make this dish. But if you're going to make an awesome dish that just is absolutely awesome, you're going to tweak it. And that's, I think, a universal truth.
Excellent. Thank you, Roger. So here's to all of us making better dishes by giving great guidelines rather than becoming too strict in how we suggest everybody does what they do. We've got a question from Fawaz Idrisi, who asks, do you see a big change or wave happening to the economy coming soon? And do you feel that if China's companies become more innovative, then their economy and system will more take over the world? What would you say?
Yeah, I mean, from a geopolitical standpoint, I just worry a great deal about China. I mean, it's and there's a battle on the next Cold War. The last Cold War was between communism as a system and democracy as a system. Full stop. Democratic capitalism, and democratic capitalism, stomped all over communism. The battle now is between totalitarian capitalism and democratic capitalism, and that's why we've got to really make democratic capitalism work. Otherwise, it'll lose to totalitarian communism or totalitarian capitalism, which is the system in place in China, and it's a battle for the future of the world. Nothing less than that. And I think, given the direction democratic capitalism is going in the US now, if we don't fix it, it will lose to totalitarian capitalism, and the world will be a considerably more miserable place.
Thank you, Roger. Next one is from Michael Fagbeiro, who asks and says, it seems like the disparity in the economy shows the fact that majority rely on wages and salary increases, while the wealthy rely on their investments appreciating. Wouldn't it help to have more of majority invested in the stock market, which would lead to the increase in wealth for everyone?
Absolutely. I mean, and Peter Drucker smartly wrote about this in 1976, the pension fund revolution, where he said, actually, more and more workers are going to own the means of production, not, as Marx said, through violent overthrow, but because their pension fund is going to be a major owner in the stock market. And he's ended up being right. Pension funds are now a huge owner of stocks. But I think encouraging kind of more of that is better, and having the kind of the already rich benefit wildly disproportionately from the stock market isn't helpful to the future of democratic capitalism at all.
Thank you so much, Roger. We've got one here from Todd Marcus. He asks, how do you incorporate standard of living changes into your analysis where the delta for median standard of living may be much less extreme than just looking at median income?
Yeah, I mean, there are all sorts of attempts by economists to make hedonic adjustments to determine kind of what the real standard of living is. And there's an argument that says, oh, well, since computers are so much cheaper, kind of now, you know, what cost you $10,000 20 years ago in a computer will cost you $1,000 now, and it's more powerful still. So actually, our standard of living has gone up more. I largely subscribe to that view, except that everybody who does that analysis starts at a given point and says, if we go back to 1960 and if we make all these hedonic adjustments, actually growth was more like 3%, not 2%. And I say, yeah, the 3 sounds high because we didn't ask the question between 1920 and 1960, if we did the same adjustment, what would have been the case, right? So I think GDP per capita, median income is just one measure. It's not a perfect measure. In fact, somebody in response to the book sent me a neat article on, what is it? Erdacetic erdacetic growth. That is a different way to measure it. That actually, he said, reinforces my my point, which was interesting. So I don't put too much stock in the precision of GDP per capita, but I think when you look at differences and what's changed, it is hard to argue that the reduction by 3/4 in the growth rate can be explained away by our computers being cheaper, because there's a whole bunch of other stuff that is way more expensive, education, healthcare in particular.
Excellent. Thank you, Roger. You know how just going off of what you just said on your earlier point, you said businesses need, you know, more than this one goal, right? Of just stock price today or your bottom line this year. Share with us for an entire economy, or actually better for society. So clearly we can see GDP growth numbers. We can see where our stock market's at, you know, obviously it keeps changing. But what would be a metric you've seen that a society can potentially endeavor to solve for that can counterbalance the focus on just the numbers? Now, of course, we got to still focus on those critical numbers like unemployment and things like that. But share with us, is there any other kind of metric that can make our societies more sustainable?
Yeah, I mean, there are a lot of attempts to do this. I know, kind of Mike Porter is doing one. There was an effort by the French who had Joe Stiglitz work on it. There's none that I would say I particularly kind of love, but I really like the effort to do it. My own view is that I care about a combination of that overall income growth in an environment where we do have redistribution that helps the poor, and particularly helps the poor with mobility. So I would measure social mobility, which is unfortunately going down, not up. So how many people from the first quintile during their lifetime can move to the middle quintile or the second top quintile? That matters a lot to me, because I think that has to be this fluidity. I also would like mobility where people in the top quintile can get to the bottom quintile by being lazy and profligate. So for me, it's, does the economy work in a way that helps out the poor? Do we have a mobility, and is the whole thing moving forward? And then finally, And is it moving forward at the cost of destroying the planet, or is it moving forward and being neutral with respect to the planet's overall health? But I don't have one measure to do that. But various people are working on it, and I think all of that work is well intentioned and potentially very valuable.
Excellent. That's great. I can't help but think, how powerful it would be if, local governments and national governments all actually did an NPS score with their citizens. Like, to what extent would you recommend this neighborhood council or your national government to a friend or colleague? And, that would be another data point because, ultimately, if people are feeling satisfied, or as a trend, that would also be an indicator. Most businesses, that's how they make a lot of decisions.
Yeah. And
Final
America has a challenge on this front of bigness, right? Like, I don't think, some of our research work behind this just said that most people have, opted out of that, and the only thing they pay attention to is very local politics. And so I would love to see us figure out as a country how to leverage that and take advantage of people's greater connection to local politics. It feels like it doesn't add up. Like it isn't as though we can take that and add it up to the national level. It's sort of, well, that happens there, and then there's a giant disconnect, and people just say, Washington, they're Looney Tunes doing crazy stuff there, and I don't even know how to think about it, let alone interact with those people.
Excellent. Roger, this was extraordinary. Final just question to wrap up. How can we and our community best support you and your endeavors? If you have a final word of wisdom to also end on, feel free. And thank you for everything you shared today.
Well, sure. Go and read the book if you like it. Give it to somebody else, or tell somebody else to buy it. But as leaders, this idea of when somebody comes to you with an either or choice that is miserable, that you say, I don't like either of those, don't, right? Don't choose, and take that as your opportunity, your leaderly opportunity to come up with a better answer. And if they say, but boss, you got to choose now, just say, no, I actually don't. That will do more to contribute as leaders to society than almost anything else you can do. Aim higher to get around those trade-offs. That is the ultimate creative act.
Beautiful. I mean, that's great. So anytime we're challenged with either or, we just say no, because we're going to be clever and find a third way. So thank you, Roger, so much. Highly recommend to everybody. When more is not better. Great work, and you gave us some invaluable wisdom today. So thank you again, and hope to see you again very soon.
I would be delighted. Thank you for having me. And I know in a couple of weeks you're having Zainab Tan. Everybody, you gotta see her. She's fabulous. She's absolutely fabulous. As a fabulous message that will be very helpful to you.
Excellent. Thank you, Roger. Have a great rest of your day, and thank you everybody for joining us. See you all again soon.
Take care. Bye-bye.
Bye-bye.